In 2026, Turkey is enacting a massive shift for digital exports. Previously allowing an 80% deduction, new regulations move the threshold to a 100% exemption. This drops Turkey's tax baseline to the exact 0% mark found in Dubai or Estonia. However, unlike traditional tax havens where residency often grants an automatic pass, this zero tax status is tied to a specific set of operational criteria. Accessing the 100% deduction requires navigating a series of strict, non-negotiable conditions. Under Turkish tax law, these exemptions must be claimed at the time of the initial filing. If a worker fails to structure their contracts or business type correctly before the revenue is received, the window to claim the 100% deduction closes, leaving the earnings subject to standard permanent taxation. Securing this rate requires meeting 3 specific criteria regarding the nature of the work, the location of the client, and the method of reporting. The first requirement concerns the nature of the work itself. The 2026 exemption is reserved for those producing specialized digital exports, specifically software developers, system engineers, data analysts, and UX designers. This applies regardless of how the client is found. Working through third-party global platforms like Upwork or TopTal satisfies the requirement for independent contractors. But the definition of an approved export is narrow. Passive revenue streams, such as income from AdSense, AdMob, or Ezoic, fall outside this classification and remain fully taxable. The legislation explicitly prioritizes the active production of digital infrastructure over passive content monetization. The second constraint involves the geography of the service. For the tax to vanish, the economic benefit of the work must be consumed entirely outside of Turkey's borders. It is perfectly legal to live in Istanbul or work from a cafe in Antalya. The physical location of the worker does not jeopardize the exemption. The risk lies with the client. If the beneficiary is a Turkish entity, the exemption is voided. Contracts with a specific Turkey reference act as an immediate audit flag. To maintain compliance, the service area must be defined broadly, like MENA or global. When this foreign consumption rule is met, it triggers an additional benefit. The mandatory value-added tax, the KDV, on all issued invoices also drops to 0. The code ignores the location of the laptop, focusing exclusively on where the economic impact lands. The final requirement of the law is administrative. There's a common misconception that untaxed income requires no formal financial declaration to the state. In reality, capturing the 100% deduction requires a formal corporate framework. For most remote workers, a simple sole proprietorship provides the necessary legal structure. Maintaining this status requires a constant cycle of compliance, issuing precise zero VAT invoices and filing both quarterly and annual tax declarations. This leads to a specific administrative reality. The more money a worker earns, the more meticulously they must report their potential liability to the government, simply to prove the final math equals 0. Total tax exemption in this system is a direct result of continuous corporate compliance. Total annual foreign income minus deductible business expenses leaves the net profit. Under 2026 rules, that entire net profit is subtracted directly as a 100% exemption. This wipes out the tax liability entirely, reaching a legal 0. But because the Turkish system requires these deductions to be declared correctly on the first attempt, any structural error discovered after the money is received makes this outcome impossible to achieve. The 2026 regulations have turned Turkey into a specialized destination for the global digital elite, offering a 0% environment that rivals traditional tax havens. Navigating this new landscape successfully depends on establishing a preemptive, compliant legal structure before the first dollar of foreign income is earned.